There are financial truths that most people learn decades too late, if they learn them at all. These aren't complex investment strategies or advanced tax optimization techniques. They're fundamental principles about how money actually works, principles that shape your entire financial life. Yet somehow nobody teaches them when it would matter most. By the time most people understand these truths, they've already made the mistakes. They've already spent decades operating with broken mental models. They've already sacrificed years of compound growth. They've already locked themselves into financial positions that take years to escape. The knowledge arrives too late to prevent the damage. This isn't an accident. The system benefits from your financial ignorance. Schools don't teach financial literacy because financially literate people are harder to exploit. Culture promotes consumption because consumption drives economic activity. Institutions profit when you misunderstand money, because misunderstanding keeps you dependent and compliant. The people who do understand money early, either through exceptional parents, unusual curiosity, or painful early lessons, gain a massive advantage. They make better decisions in their 20s that compound into dramatically different outcomes by their 40s and 50s. The gap between those who understand money early and those who don't widens exponentially over time. What follows are the truths about money that most people learn too late, if ever. You're learning them now, which means you still have time to benefit. The question is whether you'll actually change your behavior based on this knowledge, or whether you'll understand intellectually while continuing to operate the same way everyone else does. Time is more valuable than returns. Most people obsess over investment returns. Should I invest in this stock or that fund? What's the return percentage? How do I maximize gains? These questions feel important, but they miss the most powerful force in wealth building: time. The person who invests moderate amounts early and achieves average returns will dramatically outperform the person who invests large amounts late, even with exceptional returns. This is the mathematics of compound growth. Small amounts given decades to compound become enormous. Large amounts given only years stay relatively small even with better returns. A simple example illustrates this. Invest $5,000 annually starting at age 25 with 7% returns, and you'll have over $1 million by 65. Wait until 40 to start, then invest $10,000 annually with the same returns, and you'll have under $600,000 despite investing more total money. The 15-year head start more than compensates for investing half as much annually. This means the most important financial decision isn't what to invest in, it's when to start. Every year you delay is opportunity permanently lost. You can't recover lost time. You can increase investment amounts later, but you can't recapture the compound growth that would have occurred during years you spent not investing. Most people don't emotionally understand this until they're in their 40s or 50s. Then they look back and realize that starting just 10 years earlier would have meant hundreds of thousands more in retirement. They realize that the years they spent not ready to invest were the most valuable years they could have invested. But by then, those years are gone forever. Start investing immediately, even small amounts, even if you don't feel ready, even if you don't fully understand. The time you start matters more than almost any other factor. Waiting until you have more money, more knowledge, or feel more prepared means sacrificing the most valuable asset you'll never get back. Your house is not an investment. Home ownership is presented as a cornerstone of wealth building. Buy a house, build equity, and watch your net worth grow as property values increase. This narrative is so deeply embedded that questioning it feels almost unpatriotic. But for most people, their house is not actually a wealth-building investment. A house you live in is an expense that happens to maintain some resale value. It requires constant maintenance, property taxes, insurance, and often mortgage interest. It ties up capital that could be invested elsewhere. It limits mobility, potentially costing you career opportunities. It exposes you to concentration risk in a single asset in a single geographic market. Real investments produce income. A house you live in produces expense. It doesn't generate cash flow. It doesn't diversify your holdings. It doesn't provide liquidity. The fact that it might sell for more than you paid doesn't make it an investment any more than a car that depreciates slower than average is an investment. This doesn't mean home ownership is bad. It can provide stability, predictable housing costs, and forced savings through mortgage payments. But it's not the wealth-building strategy it's marketed as. The person who buys an expensive house thinking it's an investment often discovers they've locked up most of their wealth in an illiquid asset that limits their options rather than expanding them. The cultural pressure to buy houses as early and as large as possible financially damages millions of people. They stretch to afford more house than they need, thinking, it's building wealth. Instead, they're allocating enormous resources to housing expense that could have been invested in actual wealth-building assets. Their home appreciates, but their opportunity cost is massive. Treat housing as a lifestyle decision, not an investment strategy. Buy when it makes sense for stability and housing cost predictability, not because you think it will make you wealthy. Keep housing costs as low as practical so capital can go to actual investments. Your house is where you live, not your retirement plan. Income is not wealth. High income feels like wealth. The doctor making $300,000, the executive making $400,000, the consultant making $500,000. From the outside, they appear wealthy. Often they're broke. They have high income, high spending, and little to no actual wealth. Wealth is assets that provide security and options. Income is money that flows through your life. If income comes in and immediately flows back out to fund lifestyle, you're not building wealth regardless of income level. You're just operating an expensive life that requires constant high income to sustain. This distinction is critical because they require completely different strategies. Building income requires career focus, skill development, and labor market positioning. Building wealth requires controlling expenses, consistent saving, and intelligent investing. Most high-income people focus entirely on the first and ignore the second. The result is people earning several $100,000 annually, who live paycheck to paycheck, have minimal savings, and would face financial crisis if income stopped. They look wealthy through the lens of consumption, but are fragile because they've built income without building wealth. One job loss, one health crisis, one economic downturn, and their entire financial structure collapses. Meanwhile, the person earning $70,000 who saves 30% and invests consistently builds actual wealth over time. They have security that doesn't depend on continuous high income. They have options that come from accumulated assets. They have resilience because their lifestyle doesn't require maximum income to sustain. Focus on wealth, not income. High income is valuable when it's converted to wealth through saving and investing. Without that conversion, it's just funding an expensive lifestyle that creates no security. The goal isn't making more money. The goal is keeping more money and putting it to work building assets that provide real financial security. Debt is not a tool, it's a trap. Modern financial advice sometimes frames certain debt as good debt or describes leverage as a wealth-building tool. This language obscures a fundamental truth. Debt is risk transfer from lenders to you, and in almost all cases it works against your interests. Every dollar you owe is future income already claimed. Every payment is labor you've already sold. Debt doesn't give you buying power. It gives you future obligation in exchange for present consumption. The math works in the lender's favor, not yours. They wouldn't offer it otherwise. The interest you pay is money that will never build wealth for you. It's pure loss, transferred from your financial future to the lender's profit. Over the lifetime of typical debt, mortgages, car loans, student loans, the interest paid often exceeds the original principal. You're paying double for everything you financed, sometimes more. The psychological impact is worse than the financial cost. Debt creates stress, limits options, and traps you in whatever income source services the debt. You can't leave bad jobs because you need the payments. You can't take risks because you have obligations. You can't invest aggressively because cash flow goes to debt service. Debt doesn't enable freedom, it prevents it. The good debt narrative primarily applies to debt used to acquire appreciating assets that produce income exceeding the debt cost. For most people, this means never. Your mortgage on a house you live in isn't good debt. It's tolerable debt if the alternative is unstable housing. Your student loans aren't good debt unless they genuinely enabled income that exceeds the debt cost plus opportunity cost. Avoid debt entirely except for truly appreciating assets in carefully controlled amounts. If you have debt, eliminate it as aggressively as possible. Debt-free life with lower income provides more security and options than high-income life with substantial debt. The peace of owing nothing is worth more than most purchases debt would enable. Retirement planning requires uncomfortable math. Most people are drastically underprepared for retirement but don't realize it because they haven't done the actual math. They contribute to retirement accounts and feel responsible. They assume it will somehow work out. Then they reach their 60s and discover their retirement savings will last maybe 10 years, not the 30 years they'll need. The math is straightforward but usually ignored. Take your expected annual retirement expenses. Multiply by 30 years. That's roughly what you need saved, assuming reasonable returns and withdrawals. For most people, this number is dramatically larger than what they're on track to accumulate. If you need $50,000 annually in retirement and expect to live 30 years after retiring, you need about $1.2 million saved, assuming conservative withdrawal rates. Most people aren't anywhere near this trajectory. They're contributing small percentages to retirement accounts and hoping it will somehow be sufficient. It won't be. Social Security, if it exists at current levels when you retire, will cover a fraction of needs. Pensions are largely gone. Your retirement will be funded by what you save and invest, period. If your plan relies on inheritance, reduced expenses, or working longer, you don't have a plan. You have hope disguised as planning. The uncomfortable truth is retirement requires either aggressive saving during working years or accepting dramatically reduced lifestyle in retirement. Most people refuse to accept either option, so they contribute modest amounts to retirement accounts and avoid calculating whether it's sufficient. Then they reach retirement age unprepared and shocked. Do the actual math. Calculate what you'll need. Determine what you must save monthly to reach that number. If the required savings rate is higher than you're currently saving, you have a choice. Increase savings now or accept reduced retirement lifestyle later. Hoping it works out isn't planning. It's denial that guarantees problems later. Your car is destroying your wealth. Transportation is necessary. Car payments, premium vehicles, and constant upgrades are not. Yet vehicle spending destroys more wealth than most people realize because they normalize extremely expensive approaches to basic transportation needs. The new car with 5-year financing costs perhaps $35,000 plus interest. That same money invested over those 5 years grows substantially. The opportunity cost isn't just the purchase price. It's the growth that money could have achieved. Do this pattern repeatedly throughout working life and you've sacrificed hundreds of thousands in wealth to drive newer cars than necessary. Cars are depreciating assets. The moment you buy one, it loses value. The person constantly buying new cars on payment plans is perpetually underwater, always owing more than the vehicle's worth, always making payments on depreciating assets. This is wealth destruction disguised as normal behavior. The alternative, buying reliable used vehicles with cash, is treated as weird or cheap when it's actually financially intelligent. Drive a 10-year-old paid-off reliable vehicle, and your transportation costs drop to maintenance and insurance. The payment you don't have can go to investments. The depreciation you avoid preserves capital. This extends beyond purchase decisions. Premium fuel, luxury brands, excessive customization, impractical vehicles that require premium maintenance. Every car decision can either destroy wealth or preserve it. Transportation can cost $300 monthly or $1,000 monthly for functionally equivalent results. That $700 difference invested over a career becomes substantial wealth. Challenge every assumption about what vehicle you need. You probably don't need new. You definitely don't need luxury. You likely don't need the size or features you think you need. Buy the minimum reliable transportation that serves your actual needs. Pay cash. Drive it until it becomes unreliable. Everything beyond that is consumption masquerading as necessity. Financial education is your responsibility alone. Nobody is coming to teach you about money. Not school, not employers, not government, not financial institutions. In fact, many institutions profit from your ignorance, so they have incentives to keep you confused. If you're going to become financially literate, it's entirely on you to make it happen. This is uncomfortable because most people want to trust experts. They want to believe their financial advisor is optimizing for their interests. They want to assume their bank is offering good products. They want to trust that retirement plan options are sufficient. Often, none of this is true. Financial advisors are often salespeople earning commissions on products they sell you. Banks offer products that benefit the bank, not necessarily you. Retirement plans offer limited options, sometimes with high fees that dramatically reduce returns over time. The system isn't designed to optimize your wealth. It's designed to extract money from you efficiently. Becoming financially literate requires aggressive self-education. Read books on personal finance, investing, and behavioral economics. Learn how compound interest works. Understand fee structures. Learn to evaluate investments independently. Develop bullshit detection for financial products marketed to you. Nobody will do this for you. The people who become financially successful despite average incomes almost always share one trait. They took responsibility for their own financial education. They didn't trust institutions to optimize for them. They learned enough to make informed decisions. They treated financial literacy as essential knowledge, not optional. Start learning now. Read one book monthly on financial topics. Listen to educational podcasts from credible sources. Take free online courses on investing basics. Learn to read financial statements. Understand your own retirement accounts and investment options. Every month you remain financially illiterate is a month you're being systematically exploited by institutions that understand money better than you do. Your friends can make you poor. Social environment is one of the strongest predictors of financial outcomes. If your friends spend everything they earn, you probably will too. If your friends invest and build wealth, you probably will too. This isn't about peer pressure. It's about normalized behavior and social identity. When everyone around you leases luxury cars, buying used feels like failure. When everyone takes expensive vacations, staying home feels like missing out. When everyone has the latest everything, using older items feels like being left behind. Your peer group's spending patterns become your baseline for normal, making it psychologically difficult to choose differently. This creates a situation where upwardly mobile career success can paradoxically damage your financial position. You start earning more, join social circles with higher spending norms, increase lifestyle to match, and end up with higher income but no additional wealth. You've joined a more expensive peer group and adopted their spending patterns. Breaking this pattern requires either finding different friends or developing immunity to social spending pressure. Both are psychologically difficult. Reducing time with high-spending friends feels like social demotion. Maintaining friendships while not matching spending patterns requires explaining your choices repeatedly and accepting being different. But the alternative is letting your peer group determine your financial future. If you want to build wealth but your friends want to fund expensive lifestyles, you have incompatible goals. Either they'll pull you toward consumption or you'll need distance to protect your financial choices. Audit your social circle for financial influence. Who encourages spending? Who normalizes debt? Who makes you feel like your financial priorities are weird? These people, however much you like them personally, may be preventing your financial success. You don't necessarily need to end friendships, but you need to recognize their influence and consciously resist pressure to match spending you can't afford. Compound growth is magic. You're probably wasting. Compound growth is the most powerful wealth-building force available to ordinary people, yet most people never harness it because they start too late or contribute too little. Understanding compound growth intellectually is useless without behaviors that actually capture it. Money that grows compounds on previous growth, creating exponential rather than linear progression. Early contributions compound longest and contribute most to final wealth. The first $1,000 invested at 25 has far more impact than $10,000 invested at 50, despite being 1/10 the amount. This makes early investing disproportionately valuable. Your 20s and early 30s are the most important investment years of your life, not because you have money to invest, you probably don't, but because time multiplies whatever you invest. Missing these years means giving up the highest impact wealth-building period of your life. Most people do exactly this. They spend their 20s and 30s funding lifestyle, planning to invest seriously later when they earn more. By the time they start investing, they've given up decades of compounding. They contribute larger amounts later but achieve smaller results because time was wasted. The opportunity cost is staggering. $1 invested at 25 growing at 7% becomes nearly $15 by 65. $1 invested at 45 becomes just $4. The 20-year delay cuts returns by 73% per dollar invested. Time is 3 times more valuable than the money itself. Start investing immediately regardless of amount. Even $50 monthly captures compound growth and builds the habit. Focus on consistency and starting early, rather than waiting until you can invest larger amounts. The person investing small amounts for 40 years will dramatically outperform the person investing large amounts for 20 years. Time beats money every time. Nobody cares about your financial future except you. Employers don't care if you retire comfortably. They care about extracting maximum productivity for minimum cost. Financial institutions don't care if you build wealth. They care about extracting fees and selling products. Government doesn't care if you're financially secure. It cares about tax revenue and economic activity. This sounds cynical, but it's simply accurate. Institutions optimize for their interests, not yours. Sometimes alignment happens. A good employer with generous retirement matching benefits you while reducing their tax burden. But the optimization is for them, not you. You're responsible for your own financial outcomes. This means you can't outsource financial planning to others and expect optimal results. You can't assume your employer's retirement plan is sufficient. You can't trust that your financial advisor is recommending what's best for you rather than what earns them commission. You can't rely on government programs that may not exist at current levels when you need them. Taking full responsibility for financial outcomes is psychologically difficult because it means accepting that failure is your fault. It's more comfortable to blame institutions, economy, bad luck, or circumstances beyond your control. Sometimes these factors matter, but they're never the complete explanation. The people who achieve financial security despite average circumstances are those who accepted complete responsibility for outcomes. They didn't wait for employers to provide sufficient retirement. They didn't trust institutions to optimize for them. They learned what they needed to know, made hard choices others avoided, and built security through sustained effort. Your financial future is entirely your responsibility. Nobody is coming to save you. Nobody cares as much about your outcomes as you do. This is either liberating or terrifying depending on how you frame it, but either way it's true. What to do with this knowledge? Understanding these truths means nothing without different behavior. Knowledge that doesn't change action is entertainment, not education. So what actually needs to change? First, start investing immediately if you haven't. Open a retirement account, set up automatic contributions, choose low-cost index funds, and begin. The amount matters less than starting. You can increase contributions later, but you can never recapture lost time. Second, eliminate debt aggressively. Stop accumulating new debt. Attack existing debt with intensity. Every dollar going to debt is a dollar not building wealth. Get out of debt and stay out permanently except for carefully considered exceptions. Third, reduce housing and vehicle expenses dramatically. These are typically the two largest discretionary expenses that people normalize at unsustainable levels. Smaller house, older car, and the difference invested over a lifetime becomes enormous wealth. Fourth, calculate your retirement needs with actual math. Determine required savings rate to reach that number. If current contributions are insufficient, increase them now. The gap won't close by hoping. It closes by saving more or accepting reduced retirement lifestyle. Fifth, take responsibility for financial education. Read, learn, develop literacy sufficient to make informed decisions and avoid exploitation. This is ongoing work, not a one-time project. Commit to learning continuously. Sixth, audit your social environment for financial influence. Reduce time with people who pressure expensive consumption. Find peers who share wealth-building values. Your social circle will determine outcomes more than most factors you control. Seventh, separate consumption from identity and self-worth. You are not what you buy. Spending doesn't create meaning. Purchases don't solve emotional problems. Recognize when these confusions drive spending and interrupt the pattern. Eighth, create systems that automate wealth-building behavior. Automatic transfers to savings and investments. Barriers to impulsive spending. Sinking funds for irregular expenses. Systems compensate for motivation fluctuations and ensure progress even when you don't feel like making good choices. Why people ignore this? Until too late. These truths are not secret. Books, articles, and advice cover these topics extensively, yet most people ignore them until they're in their 40s or 50s facing the consequences of decades of ignorance. Why? partially because the culture actively works against financial literacy. Consumption drives economic activity, so the culture promotes consumption. Financial independence reduces dependence on institutions, so institutions don't promote it. The path of maximum social acceptance leads away from wealth building, partially because results are delayed. Invest today, and you don't see meaningful results for years. Meanwhile, consumption provides immediate gratification. Human psychology is biased toward immediate rewards over delayed benefits, making wealth-building behaviors feel unrewarding, partially because it requires accepting present discomfort for future benefit. Smaller house means less space now for more security later. Older car means less status now for more wealth later. Reduced consumption means less immediate pleasure for more options later. Most people won't make this trade, partially because it requires thinking independently. When everyone around you thinks conventionally, choosing differently than your peer group feels weird, creates social friction, and requires explaining yourself repeatedly. Social acceptance feels more important than financial security, partially because the problems feel distant until suddenly they're immediate. The 30-year-old underinvesting for retirement doesn't feel the consequences. The 55-year-old facing retirement with insufficient savings feels them acutely. By then, the easiest years to fix the problem are gone. This explains why financial advice is so abundant yet so ignored. People hear it, understand it intellectually, and continue behaving the same way. The advice conflicts with immediate comfort, social norms, and psychological biases. Following advice requires sustained effort against all those forces. Most people aren't willing. The dividing line. There's a clear dividing line between those who build financial security and those who don't. It's not intelligence, income, or luck. It's willingness to learn these truths early, accept them emotionally, and change behavior based on them even when change is uncomfortable and socially awkward. One group hears this information and makes different choices. They start investing in their 20s even with small amounts. They avoid or eliminate debt. They keep housing and vehicle expenses low. They build wealth slowly over decades through consistent behaviors most people won't sustain. The other group hears the same information and continues operating the same way everyone else does. They'll invest seriously later. They'll get out of debt eventually. They'll reduce expenses someday. They understand intellectually but change nothing behaviorally. Then they reach 50 or 60 and realize later never came. The difference isn't knowledge. Both groups have access to the same information. The difference is willingness to act on knowledge even when action is uncomfortable, unpopular, and provides no immediate reward. The difference is accepting that financial security requires sacrifices most people won't make, and consistency most people won't maintain. Which group you join is entirely your choice. You can understand these truths and change nothing, joining the majority who reach old age financially unprepared. Or you can understand these truths and let them reshape your financial behavior, joining the minority who build actual security. The truths about money don't change. They operate regardless of whether you accept them. Ignore them and you'll still experience the consequences. Understand and apply them and you'll benefit enormously. But understanding alone changes nothing. Only different behavior creates different outcomes, and different behavior is what most people won't sustain long enough to matter.